Yeah, hello again. Here is the continuation of some remarks concerning tax rates and tax base. That is a part of General Introduction to Tax Law, the beginner's lecture for people in the first semester. Yeah, then let's start with going on with our contents. Okay, just to remind you where we are at the moment. Um, we talked here in this chapter about general characteristics of the tax system, and we have already talked about the different kinds of taxes, and now this subchapter here deals with the tax bases and tax rates, what one can generally draw as conclusions or as rules for these aspects. Now, I told you last time that several private expenses can or should be deducted from the tax base, namely these expenses which the taxpayer cannot avoid under all circumstances. So, where there would be no ability to use these amounts for paying taxes. So, we should, um, we should develop the income into the disposable income, so what you freely can use. Now, on the other hand, concerning private expense, there is naturally not only the private expense which you necessarily need to survive, but the real fun for you and me naturally lies in that expense which we can freely decide to make or not to make. So the question is now, what for a general rule can we find here? And the answer is, in general, most tax systems of the world will end up with the conclusion that such private expense should not be deductible from the tax rate. So, as special personal allowances, a basic allowance for the survival needs, and extraordinary expenses probably must be explicitly described in the law, we can even end up with the conclusion there should be a general rule that every expense which is of a private nature, so has nothing to do with your job, should be not deductible from the tax base, and that only those things which I just mentioned, so the necessary private amounts, characterized more clearly in the individual tax law, that only these should be deductible. And indeed, you find such a rule in most tax systems of the world. Now, the question is, why is that the case? Here, my first proof that it exists. You see this in section 12 of the German Income Tax Act. This is the ESTG, Einkommensteuergesetz. By the way, I always propose you, if you cite a foreign law which has an official abbreviation, that you should stick to the abbreviation which is customary in that country. Because if you, for example, translate Einkommensteuergesetz, it would be Income Tax Act. But if you then choose to abbreviate that by ETA, then nobody will ever understand that who is familiar with German law. Whereas if you, as an English-speaking person, later speaks to German and you refer to paragraph 12 ESTG, everybody will know what you are talking about. And even if you talk with another English-speaking person, if you use the abbreviation ITA for Income Tax Act, then probably, or perhaps at least, that other English-speaking person has translated the term Einkommensteuergesetz in a perhaps slightly different way and uses a slightly different abbreviation. And so your ITA just causes chaos on the other side. That's the reason why you will always find abbreviations like ESTG in my headlines here. Now let's go back to the things which really matter. That is, for example, here our paragraph 12 ESTG of the German Income Tax Act just says that private expense is not deductible. Then they make a list of especially what counts as a private, not deductible expense. For example, all the costs of living, all the voluntary payments which one makes on grounds of voluntary obligations, or anything else to persons, again, for which the taxpayer or his spouse gives financial support, or the taxes on income, also non-deductible fines and other criminal punishment payments or so, and even the expense for professional first education also is listed as non-deductible expense. Now let us turn back to the question of the tax tariff. I have already outlined to you how a tax tariff can look like. The theory beyond that was explained. And now here you see a real tax tariff from Germany. Here that was the version of 2014. And you see here the first bracket is a zero bracket and ends at 8,354 euro. That was estimated at that time the subsistence or survival level, which, or basic allowance as it is called in German, Grundfreibetrag, which shall correspond, or is meant to correspond, to what you need to survive. Now we would expect that in the course of time this basic allowance due to inflation should be going up, and indeed if you look now to the development of that specific rule during the next years, you see in the 2015 variant the basic allowance has already been increased by approximately 150 euro to now 8,472. And if you look through the years, then you see in the variant of 2020 the basic allowance was fixed to 9,408. So you see there are constant changes in the way how such a tariff is made. Now if you look to the details here, the formula is relatively complicated with X's and Y's and Z's. The background of that is that the Germans, as always, have that tendency to do everything in the most complicated way, whereas many other countries have a tariff function which is as simple as the one which I developed in the beginning as a fictitious tariff, with 5 brackets, 5 zones of different tariffs. Some people argued, well, if you pay 10% and then it leaps up to 20, isn't that rather harsh? Shouldn't we increase that gradually? And the answer is, why? What they thought, the increase from 10 to 20, from 1 euro to another, that's rather hard. We should do it gradually. So we should make the brackets smaller and the steps smaller. So instead of 10 brackets, let's say 100 brackets with half a percentage where the amount leaps up. And then naturally you see why stop at 100 brackets. So they went to a mathematician and said, can't we develop a tariff function mathematically where the brackets are infinitesimally small and where the percentage per euro goes up by very small steps, so from 1.11% to 1.12% for the next euro and then so on. And can't we make a mathematical model which leads to that result? And the problem is, if you ask mathematicians, they always can. And that is the reason why here in Germany we have such a complicated tax tariff function that in the end no single citizen who did not study mathematics is able to understand what's behind that tariff. But in the final effect, even that complicated tariff is nothing else than an extreme form of what I explained to you in advance. So here, all your income during a year is added up to find out how rich you really are. and then you go with the total value to that tariff function and find out how much the total income tax is which you have to pay for that year. And beyond the construction, unseen by you, is, let's say, a multitude, a big amount of brackets, which are all only €1 small, where the marginal tax rate, so the tax rate for the next euro, climbs up in very small steps. Good. Now, naturally, we have some additional problems to solve. First, when you look to the tariff function, again, let's go back to 2014 or so. Here you see there are some amounts which are, here for example, which are deducted here at the end. 42% minus 8261.29 in 2015, or for the super rich ones, even 45% on everything minus a deduction. The explanation for this deduction is simply that this deduction rectifies or corrects the fact that if you calculate 45% on everything, that's too much, and that is so simply a correcting factor. Whenever it comes to talking about the income tax tariff, two important different terms have to be kept in mind. First, the marginal tax rate, that is the tax rate, the percentage of the income which you have to pay for the next euro or for the last euro of your income. And then the average tax rate, which is considerably smaller, that is the amount of all your taxes divided by all your income. That must be smaller than the marginal tax rate because you begin with a zero tax rate and then it goes up. And so if your final marginal tax rate is 45 and the first tax rates are lower, then naturally the average tax rate must be lower than 45, naturally. Mathematically not possible in a different way. Here there would be a simple task. Are you able to calculate based on the income tax tariff for a given year? Here on the slide I asked 2014, but nowadays you would perhaps use the 2020 tariff or so on. Are you able to give the payable tax? Naturally you are, because at least in the upper zones or in the first zone, calculating the tax would be relatively simple. In the middle, where the tariff function is a game for mathematicians, there you would probably use a computer or tables or computer programs available on the internet. Now, when we apply such a tariff, we still have a problem, especially if one has also income which is tax-free. We have not yet spoken about that, but very often there are certain amounts of money for which you have good reasons, if you are parliament or if you are the state, to leave that income tax-free. For example, especially in an international area, it might be possible or even necessary that the state says, a part of your income from all over the world will be not taxed here. It will be left tax-free here because it is already taxed somewhere else. First, you need a special law for that, a special rule which deviates from the general rule that all your income counts. But if there is such a rule which says this part of the income is tax-free, then you get a problem with the tax tariff, because our basic logic was rich people should pay a high rate, poor people a low rate, and people in the middle should pay a rate in the middle. Now the problem is, if a part of your income is tax-free, then you look poorer in your tax declaration than you really are. Imagine you have a worldwide income of 500,000 or even of 1 million, let's say 1 million. And now 990,000 of that income are tax-free in Germany because that is already taxed in France with a brutal tax rate. So the German law says we don't tax your French income, we only tax the rest. And now this rest is 10,000. Well, now imagine which rate would be adequate. Well, usually if you have an income of 10,000, your tax rate will be relatively low. Usually if you have 10,000 euro, you pay a tax of 130 or so. I don't know, it varies every year, but it's a very small amount, let's say 1% approximately. Now the problem is, if you have a closer look to what happens, that person pays 1% tax rate, although that person is a millionaire. And that 1% is the average tax rate for the German income. That's evidently not adequate for a person who is so rich. Well, now imagine one could even use that as a nice trick. Imagine you are a millionaire, but you distribute your income over, let's say, 200 countries of the world. Then you have, well, 5,000 euro in each country. So if they all have a similar logic, they would all regard you as poor, 5,000 euro. Nothing. Evidently, that would be wrong. In reality, you are rich, and so you deserve the rate for the rich. Now the question is, if something is tax-free, how can we ensure that the rate nevertheless fits the personal circumstances of that person? And that is one of the reasons why in all the situations, or nearly all the situations where a taxpayer also has some tax-free income, one makes an additional auxiliary calculation to determine the correct tax rate. The trick is simply, if you have somebody who has a taxable income of 10,000, but in reality, including the tax-free parts, that person has 1 million. Then one would first make an auxiliary calculation. If the whole million were taxable, how much would that person have to pay? How much would that be in percent? Because then you find out how much a millionaire, according to the view of your tax law, how much such a millionaire normally should pay in percent. And then you say, okay, we told that person 990,000 are tax-free in our country, but the rest of your income will be taxed by us by or with the tax rate which is adequate for a person of your personal wealth situation. So if a millionaire would normally have to pay 448,000, that's just an idea of mine now, that would be equivalent to 44.8% in the average. So according to the usual ideas of our tax tariff, a millionaire should deserve a tax rate of 44.8. That is what we found out by that auxiliary calculation. And then we told you, you only need to pay taxes on 10,000 in our country because other things might be tax-free. But these 10,000 which we can tax will be taxed with that tax rate which is adequate for your personal situation. So we don't demand 1%, 130 euro from 10,000. We will say we apply your personal adequate tax rate to what is still taxable in our country. So 44.8% will be levied on the 10,000 which are still taxable and not tax-free. So whenever somebody has tax-free income, for the tax rate, if one really wants to be fair and say the rich ones pay a high rate, the poor ones pay a low rate, the tax rate must then be determined by an auxiliary calculation. This clause or special rule in the law which says if you have also tax-free income, then the rate will be determined by an additional auxiliary calculation based on your whole income. This clause is usually called the proviso, which safeguards or holds up the progression effect of the income tax. And so it's called proviso safeguarding progression. In German, it's called Progressionsvorbehalt. That exists also in other countries because they all have the same problem. Yeah? I summed that up here on that slide. Here you see what would happen to somebody if in a very extreme situation 500,000 are there, but 490,000 are tax-free due to a special rule and only 10,000 are left over. If you only look to the 10,000, you will end up with a tax rate of less than 3%, which is evidently not adequate for somebody who has 500,000 of income. That person is extremely rich, and so you would solve the situation by doing the auxiliary calculation, the proviso safeguarding progression calculation, by just calculating the total tax which would be due if there were no tax exemption. Here you end up with 209,239. That was the value of 2014. I had no motivation to recalculate that every year. So if you now find out 209,239, how much is that in percent in relation to the whole worldwide income, then you end up with 41.8478%. So according to the ideas of our tax system, somebody who has 500,000 should pay a tax rate, an average tax rate of 41.8478%. And so we say, okay, if 490,000 is tax-free in Germany, nevertheless, that what we can tax will be taxed with the adequate tax rate, which corresponds to the individual wealth of that taxpayer. And so we take these 41.8% and apply them to the taxable 10,000. So we end up with a tax claim of 4,847. Sometimes it's even difficult to pronounce such an enormous amount for such a small income. Yeah, but it would be socially correct. Remember, please, such an auxiliary calculation is only necessary when you have, or if you have tax-free amounts. Only then your income, which is taxable, conveys a wrong impression of your total income. So of the question if you are poor, medium rich, or really rich. So that is only necessary if tax-free income is there, which might be the case. Naturally, you then need also a legal basis for that, which says that tax-free income shall be introduced in that or used for the auxiliary calculation. That is then in the German law in section 32b. However, not every tax-free amount will be included in the auxiliary calculation because simple reason. There are some tax exemptions which have been made to save the fiscal administration and do the work to compute that money. For example, the financial advantage of having the possibility to ride a bicycle of your employer for free is in theory a financial advantage and a part of your income. Now, if somebody says quantify that, you will probably say, oh no, oh Lord, let me die. Because that will be really difficult to compute. The tax which is due in the end will will be a very small amount, and you will spend hours in disputes over the calculation. And so that is one of the reasons why the law, for example, says that's tax-free. Or when you work as a waiter in a restaurant, you get tips from the guests. In principle, that's income. Now the problem is, nobody can ever check if the amount of tips which you declare as additional income is correct or not. So honest people have to pay, dishonest people don't need to pay, and nobody can ever prove what they have hidden. And that's an impossible situation. And so, due to practical reasons, because it's definitively not possible to find out the real amounts which waiter gets as tips, the German law at least took refuge to a drastic solution. There is a rule in the ESTG in paragraph 3, here in number 51, that what a waiter gets as a tip in a restaurant is declared tax-free. So the whole problem is wiped off the table. Naturally, if the inner justification of such a tax exemption is that we don't want to quantify the amount to save the work, then you cannot say that for the calculation of the tax rate you then have to compute the stuff. That would make no sense. So naturally there are certain tax exemptions where the amount is even ignored for the auxiliary calculation of the tax rate, whereas other amounts where the amount can easily be known and where there is no argument to leave that out of the tax rate calculation, where other amounts are taken into account when it comes to calculation of the tax rate. Okay, so in principle, here you see again how it would be done if you have an income where parts are tax-free. You would look to the taxable parts of the income first, would then say that is what I have to multiply times the adequate tax rate, and in order to find out the adequate tax rate, I would look to the worldwide income, to everything that person has. So that is the taxable parts of the income plus all the tax-free parts which are mentioned or which are relevant for the auxiliary calculation. That will be nearly everything. Then I would compute the tax which would be due if everything were taxable. Then I find out how much that would be in percent. Then that gives me the adequate percentage which a person with that overall worldwide income, which such wealth would have to pay from our perspective, and that adequate, just and fair percentage is then applied to the taxable parts of the income, and then you find the tax which must be paid. Good. Yeah, here was an auxiliary calculation. Okay, some exercises which we are not going to discuss now. Overview, there you can look that up in the tax rate. And then you have an additional problem. That is the so-called splitting system for the taxation of married couples. What is there the problem? If you have a progressive tax, then it's clear the more a person earns, the higher the percentage of the tax becomes. So it makes a huge difference if one person earns 60,000 euro or if two persons earn 30,000. Now, for married couples, that poses a problem. If, for example, the husband does all the paid work and the wife does the unpaid work at home, then nevertheless, the two together only have 60,000 available to live from. That means that 60,000 are now necessary for the life of two people. Whereas if somebody is single, that person can use 60,000 to live alone. And naturally, if you want that your tax rate corresponds to the wealth which people have, if they are rich or poor, naturally it makes a big difference if 60,000 are available for one person alone, and you are relatively wealthy, or if two persons have to live from that, then you are far not so wealthy. So the idea behind the tax system, the idea what the tax system, how the tax system reacts to that, the idea is we should take account of the fact that sometimes two people must live from one income, or that two people pool their income together and live together from that total amount. Usually that is the case in the case of married couples, because there usually they share their standard of living irrespective of who earns the money, and usually that is even enforceable under civil law. So here the tax system should react to realities and should take into account that the income of two people is usually needed to serve the two people. Okay. So what does that mean? If you want to see how the real situation is, one can make a relatively simple approach. Two partners earn income, add the two incomes together, then you have the total money which the two have at their disposition. And then it's clear that if they usually share their standard of living, that each of the two partners has half of that total available for living. So if you have a single person who earns 60,000, you should base the tax rate on the wealth of 60,000. If you have a married couple which has 60,000 as a total, you should take into the consideration that every one of them has 30,000 to live from. So you should base the tax rate on a wealth of 30,000. On the other hand, if you have two married partners where the one earns 70,000, the other one earns 50,000, then the total is 120,000. And then sheer logic says if 120,000 is the money from which two of them have to live, then the average which every one of them can spend is 60,000. So then the tax rate for the two should be identical to the tax rate of a single person who has 60,000 available for spending that money. And this leads to the consequence that one should perhaps offer at least the possibility that married couples can be taxed together. So the mechanism would be that the income of the two married persons, the two married partners, will be added up, that you find out what the two of them together have as total income. Then you can draw the conclusion what is the income which is now available or disposable for each of the partners. That's just half of the total income. And then you can compute for each partner the tax which, according to the regular tariff, is due for that income. So that is why that special mechanism is called the splitting tariff, because you add up the income of both partners and then split it by two. into two equal halves and then assess or tax the both partners based on that average income. You can do this for every income situation. The important economic effect is that it plays no role which part of paid work and which part of unpaid work each of the partners does. The tax situation or the tax burden only looks to what the two partners together have available to spend per person. So it really takes their personal effective wealth or income, being rich or poor, into account. And so that's fairer than just ignoring that they are married, because again, imagine the situation, somebody who alone has 60,000 disponible is far better off than a person who earns 60,000, but two persons have to live from that. That seems to be clear. In the end, that leads to the effect that it plays no role if both partners take a half-time job, or one takes a full-time job and the other one has a full-time job at home, or whatever they like. Or in the end, the only thing which counts is how much money do these people have available together, and what is then the average income which both of them can use, because that seems, at least in the case of married couples, to correspond to the economic reality. By the way, now you will say, under civil law, I have no right to the income of my husband or wife. In principle, yes. But in real life, you don't find the situation that, let's say, he spends millions and she is poor. I never found somebody, perhaps I have the wrong acquaintances, but I never met someone where he wore designer clothes and suits for 10 or 20,000, and she had only H&M second hand. For example, well, she only has 200 euro a week. I spend 1 million. When we go on holiday, I book a first-class hotel and my wife goes to a hostel, lowest price category, because she can't afford more. That really does not happen in real life. And civil law even gives an instrument to the partner with a lower income to enforce an equal distribution of the income, because at least under German law, when you are divorced, you have a right to half of the increase in wealth which your partner could achieve during the marriage. So imagine he really wants to keep all his money for himself, and is not willing to share with her. Then she can say, hey, darling, I have come across a lawyer recently. Lawyer told me that when I apply for a divorce, I get half of all the money which you saved up during our marriage. Oh, what about a new car? Then he will probably think, okay, new car, 30,000, divorce, 5 million. Here, darling, is your new car. By the way, why such a cheap car? Or what about a fur coat in addition? Perhaps you like that. I want to show myself generous because I must make you forgetting that divorce alternative. So in reality, the weaker partner always has an instrument to enforce a fair share a fair sharing of the income which comes in. Otherwise, if the partner who is rich overdoes it, there will be an unpleasant wake up. Yeah? Okay, so recently Germany, as other countries, has in the course of giving equal rights to homosexual partners also accepted marriage between homosexual couples, so that poses no problem any longer. So also they count as married couple nowadays, so that would be no extraordinary situation. That can vary from country to country. The tendency is more and more that a married couple of the same sex qualifies for the same treatment because their real situation, especially economically, is in most states the same situation as a different sex couple, and so that also has been accepted by tax law. In Germany, that has only happened during the last 10 years, I think. But it has happened and nobody is going to question it anymore. So you see, there are naturally also some times where development in society and social norms also will be accepted and reflected by the tax legislation. One other thing I should mention, let's go back to that. Usually that splitting assessment, so taxing the two married partners together and then taxing every partner on the average income, that is always more favorable to the partners, to both partners, than if the marriage were ignored. Now, fascinatingly, under the German basic law, so the German constitution, the Article 6 says that the state has the duty to sustain or support marriage and family. They are protected against discriminations. Now, you can usually not base any concrete demands on that, but at least you can follow or conclude from that a marriage and the existence of a family must never lead to disadvantages. And so the Constitutional Court in Germany has constantly ruled that no tax rule ever is allowed to lead to disadvantages for a married couple in comparison to singles. Due to that, it could be possible that perhaps this joint assessment with the splitting procedure might lead in theoretical problematic cases to a higher tax than if the two were not married and taxed separately. So the consequence which the legislator in Germany drew from that in order to be on the safe side is that married couples were given the opportunity to choose if they want to be taxed as regularly, so as married couples with a joint assessment and taxation based on the average tax rate for both of them, or if they prefer to be taxed as if they were not married, so separate tax notice for and separate tax calculation for both of them. Indeed, there can be found cases where it happens that the joint assessment leads to a less favorable tax treatment, but I must admit it took me at least 10 or 20 years to be able to imagine a first situation of that character. So that is very, very rarely the case. So, but the possibility to choose must be offered to them, and that is what the German rules do. Now, naturally, when it comes to the details of that splitting procedure, um, it's a deviation from general rule, so one will have to lay out the conditions under which that is possible or under which that is offered. The Germans say it's only for married couples, so first condition is you must be married. Second, you must live in Germany. Yeah, and the marriage must really be a marriage, so it must not only exist on paper. They do not want to support or to grant that treatment to a marriage where in reality the partners are separated and live in divorce, because then in reality the standard of living is no longer equally shared. That leads us to the following three conditions. Both partners must be subject to the so-called unlimited tax liability. What that is comes later. They must be legally married or have a respected civil partnership under civil law, so official. So mere living together is not sufficient. Yeah, it's clear, because if you just live together, one partner and the other can still handle their financial affairs very separately. The weaker partner has no instrument really to enforce a fair share of the common wealth, because if you say, "Oh, I'm leaving," well, then partner says, or with whom you just live together, yeah, okay, then leave, and you don't get any money. The situation in a marriage is different. There you can say, "What about a divorce? And then I take half of your money, and you get half of mine." So our wealth will be equalized at least at the last second, and that can be enforced in reality under civil law. That makes an important difference in the economic situation, and that is why perhaps the inner justification why that possibility or that splitting procedure is reserved for married persons. The justification is if you live together, everybody can marry nowadays, and so if you don't marry, your problem. And just to be sure that the marriage is not in reality only continued on paper, the third condition is that the splitting procedure is only granted to that couples or partners who are not permanently separated. So you must live together. It does not play a role if you are, if for example one of the partners is working abroad for a year or so. The question is if there is a permanent separation. So if the partners have decided to terminate their living together. So if the marriage is no longer a real marriage. For example, if one of the spouses gets sick and needs to go to hospital, that is not a permanent separation. Even if in hospital they tell you your spouse will probably spend the remaining time of his or her life here in the hospital, that is nevertheless not a permanent separation, because the partners didn't separate their homes with the intention not to continue their usual married life. As long as the partners continue their married life in the way which is under these circumstances still possible for them, there is no permanent separation. Permanent separation means you separate with the intention to terminate your joint life. Good. Condition number 3 is necessary, because otherwise you would find people who just marry in order to get a joint assessment and to lower the tax rate or so. Good. So here we have that in the Tax Act. We have the right to choose. And naturally, as many people do not understand the details of tax law, there is even a legal assumption here at the end of section 26, or paragraph 26, section 3 ESTG, if the spouses do not say anything on what option they choose, then it's automatically assumed that they choose joint assessment, because in 99% of the potential constellations, that is the best option for them. And so that is the default option if they don't talk about it. Good. Yeah. So here we have some overview about potential cases. And then a last remark. I told you already something about the donations to charity, which very often are deductible from the tax base. That is the case in Germany. That will also be found in Great Britain. That will be found somewhere else very, very often. Naturally, there might be conditions for that. So the fiscal authorities will reserve the right to check if the institution to which you dedicate money is really an accepted and checked charity organization, so that the money which you give away really serves only the interest of the public. And usually that is the reason why they restrict that to donations in their own area, because only there they can really go and check what happens to the money. Very often charity organizations are church, science, or other things explicitly acknowledged by state law. And in the EU, it has been enforced that a member state also has to acknowledge the charity organizations in other member states, if according to its own standards. So they would qualify as a charity organization if they were in the indent. For example, if Germany has to decide about the deductibility of a donation, Germany has to accept a donation to a French organization if under the German standards in the German law, that French organization would qualify as a charity organization. We are not bound to accept everything which the French law declares as a charity organization. German standards have only to be applied fairly also to French organizations. And so German law, German standards. So if the French declare something as charity organization, that not automatically means that the Germans have to see it also as a charity organization. They can decide on their own what they qualify as such. Okay. Now what you should know is that many states say donations are a nice thing, but we set an upper limit for the deductibility of such donations. The idea is, imagine what would happen if all citizens would donate nearly 90% of their income to charity organizations, to universities, or to other institutions. Then you would be left over with nearly no tax base. And then the state would not have tax revenue to finance those institutions for which nobody wants to donate. For example, I can imagine that people donate to the Red Cross, that they donate to universities, that they donate to churches, religious organizations, but I cannot really imagine that you find people who want to donate to pay for the fiscal offices, for the army, or for the police. So that is the reason why the state wants to guarantee that a certain amount of the income of the taxpayers is reserved as tax base and remains and cannot be used, or at least not be deducted because of donations. Here in Germany at the moment, the deductibility limit for donations is 20%. So 20% of the total income can be deducted for donations. If you donate more, that would be your private problem. So just to make clear, you cannot deduct 20% of the donation from the income. You can fully deduct your donation from the taxable income up to a limit of 20% of all you have. So if you earn $1 million, after all your personal allowances and so, and all after your necessary private special expenses, then you can make donations up to 200,000, 20% of the million. Up to 200,000 can be deducted as donations from the taxable income. If you donated 300,000 to the Red Cross, then you could still deduct 20%, so 200,000 of your income, and the rest would be then cut off. Even to facilitate even such a generosity, the Germans some years ago have introduced donations carry forward. So the amount which was cut off this year could be deducted up to the limits from your taxable income of next year, because we don't want to hinder the people to donate. The inner sense of that deductibility limit is just to take care that for the state, a minimum amount of your income, here 80% of your income, remains as a tax base, which then leads to taxable revenue, which finance all the unpopular things like police, tax officers, army, politicians, and other things. Good. Yeah, that should be enough for today. And the details are not so interesting, at least not in general for us. So that shall be enough. A last hint, what you should read is, for example, have a glance on the translations of section 10 of the ESTG, where you find things which have been accepted as special expenses, and you see then, for example, the limits which the legislator set there. Keep in mind the list of things which a legislator accepts as necessary private expense and allows you to lower the tax base by them. That will vary from state to state. So the German rules there only give an example. And a nice task would again be take a good book on the tax law of your home state and try to find out if there is also the possibility to deduct private expense, which is absolutely necessary for survival, and find out how that is done technically in your tax acts. Okay.